All right, let's talk twin Vee PowerCats, ticker VEEE. Their latest earnings report just dropped, and on the surface, things looked pretty good. But the stock got absolutely hammered. So what's the deal? What did Wall Street see that the company's press release didn't exactly highlight? Let's dig in and figure it out.
Yeah, this is the big question, right? You've got revenue heading in the right direction, costs getting chopped down, and yet the stock just plummets, almost 19%. It's a real head-scratcher. So to really understand this disconnect, we've got to start with the story that management wanted everyone to hear. Let's look at their headline numbers.
Okay, first up, the top line. Revenue came in with nearly 10% growth year over year. Now, in this kind of market for boats, that's actually pretty impressive. You have to remember, this is the first time they've seen year-over-year growth since way back in early 2023. So check one for the positive column.
And then you get to the margins, a 910 basis point expansion. Now, for those of you who aren't swimming in financial jargon, that's a massive 9.1% jump in their gross margin. What that tells you is they're probably getting more efficient at building their boats and holding the line on prices. Another really solid sign.
So, let's put it all together. You've got revenue up, margins way up, operating costs slashed by more than half, and their net loss, they cut it by almost 2/3. Oh, and they also padded their bank account, ending with $6.2 million in cash. You look at this table, and on paper, it honestly looks like a home run, a major turnaround in the making.
So the natural question is, how'd they pull this off? Well, if you listen to the folks running the company, this wasn't just some lucky quarter. They'll tell you it was the result of a very deliberate, very disciplined game plan.
And this right here was basically their mantra on the earnings call. Protect the balance sheet, keep prices firm, and don't build boats just for the sake of it. Build what dealers actually need. You know, in a really choppy market for boats, this is all about playing defense. They're trying to build a fortress, not just chase every last sale.
And look, it wasn't just talk. They had some real proof points. They bought a premium brand, Bahama Boat Works, to start playing in the high-end space. They launched a new, more affordable model to cover the other end. They even added 10 new dealers. But the really big one? They cut the number of boats sitting on dealer lots from around 160 down to just 50. That's huge. It shows they're not just flooding the channel. All solid moves.
So the narrative management is pushing is pretty clear, right? They're basically saying, hey, the whole industry's in a slump, so we're using this time to get our house in order. We're getting leaner, smarter, and setting ourselves up to crush it when the market turns. And you gotta admit, it's a pretty compelling story. It sounds like exactly what a smart management team should be doing.
But, and this is a big but, the market heard that story and just wasn't buying it. Not at all. So now we have to flip the coin and look at this from the market's perspective. What did they see that made them so skeptical?
And this slide really gets to the heart of the conflict. It's like two different conversations happening at once. On one side, you have management yelling, look at all the great stuff we're doing internally. We're building a much stronger company. And on the other side, you have the market shrugging and saying, that's cute, but you're a tiny fish in a very stormy sea, and we don't think that storm is ending anytime soon.
And this is what that market verdict looks like in cold, hard numbers. A little drop on earnings day, sure, but then the floodgates opened. A massive 16+% crash the very next day, and a lot of shares were changing hands. This wasn't just a few nervous sellers. This was what you'd call a conviction sell-off. The big players were heading for the exits.
Now, to be fair, the market's fear isn't coming out of nowhere. Twin Vee isn't operating in a vacuum. The entire powerboat industry is taking a beating right now. You've got the big industry association, the NMMA, reporting sales are down big time. We're talking 7 to 13%. Why? Well, with interest rates this high, getting a loan for a big-ticket toy like a boat is just a lot harder and a lot more expensive.
So with that gloomy backdrop, where did investors find the final piece of evidence to justify selling the stock? Well, sometimes the most important information on an earnings call is what's not said. You have to really listen to the silences and read between the lines, especially when it comes to guidance and the Q&A.
And boom, here's red flag number one for investors. Management didn't give any specific financial guidance. No numbers for next quarter's revenue, no targets for margins, nothing. They just kept repeating that they'd stay disciplined. To an investor, that vagueness screams one thing. We have no idea what demand is going to look like.
And then there was this. The moment at the end of every earnings call. The operator comes on and says, we will now take questions from analysts. And what followed? Absolute crickets. Zero. Not a single question. Now, for a small company like this, that is a deafening silence.
It basically tells you that the professional money managers, the Wall Street analysts, they're either not paying attention or they've already made up their minds. It's a huge vote of no confidence.
Okay, so let's put it all together. You have this great story of internal improvements crashing right into a brick wall of a terrible market and investor apathy. So where does that leave us? What should we be looking for in the next quarter? Let's get into our outlook for Q3.
Our thesis for why we're cautious here really rests on three main points. First, those big picture economic headwinds, like high interest rates, they're not just going to vanish overnight. Second, Twin Vee is a small company. They just don't have the financial cushion that a bigger player might have to ride out a long slump. And third, all the cool stuff they're doing, that's not going to really move the needle on their financials for a while. Those are longer-term projects.
So what does that mean in terms of actual numbers? Well, here's what we're predicting. For Q3 revenue, we're thinking it'll be flat, maybe even down a little from Q2. That initial bump from stocking up new dealers is probably over. As for those great margins, we think they could get squeezed a bit if they have to start offering discounts. And the stock price? It's probably going to be stuck in the mud, either treading water or slowly sinking until we see some real proof that people are buying boats again.
And all of this leads us to our official rating for Twin Vee going into the next quarter: underperform. Look, we see the good work they're doing on the operational side, and we give them credit for it, but we just can't ignore the hurricane-force headwinds blowing against the entire industry. For the near future, we think those macro problems are going to completely overshadow any internal progress, and the stock is likely going to do worse than the overall market.
And as always, this is not financial advice.